Robinhood lost $57 million on a meme stock. And in the course of 24 hours, the stock price tripled. They had a new story that came out and the stock price went back exactly to where they started. And in the end, there were some winners and there were some losers, and Robinhood was the big loser. By the end of it, they lost more than the entire stock was valued by the end of the day. So today we're gonna break it down into 3 parts. We're gonna talk about what happened that caused this mistake because I think it's kind of hilarious. Number 2, we're gonna talk about short selling and the dangers behind it and why I would avoid it at all costs. And number 3, we're gonna talk about why people are pretty happy that Robinhood made this big mistake and why people on the internet hold a grudge and they hold it for a long time. So what happened that caused this mistake? Robinhood is a trading platform that started out mainly as an app targeted at newer investors, and the whole reason why I'm so positive on Robinhood for the most part is that they got rid of commissions. Commissions were the fee that you paid to your broker for every transaction that you made, and it was a dollar amount, not a percentage amount, so it really hurt smaller investors. Think about if you're making a $10,000 trade and there's a $5 fee on it, not that big of a deal, but if you're buying $25 worth of stock, and there's a $5 fee on it, that is a huge deterrent from investing in the stock market, and the whole point of this channel is to get people investing as quickly as possible. So they've done a lot of positive for the community overall, but they made a huge mistake. Cosmos stock, Cosmos Health, was in danger of going pretty much under. It was sitting around the $1 valuation, and there's a rule put in place by the NASDAQ that a stock price has to be over $1. It makes it so that stocks look valuable and they don't seem like penny stocks. And there's a couple ways that you can go about making so that your stock is above $1 at all times. You can make sure that you're running an incredible business, making lots of money, and then you're making it so that it looks attractive for investors to buy into, or you can take the easy way out, which is a stock split, which is what happens most of the time. A stock split is the idea of artificially changing the number of outstanding shares out there, and it makes it so that these stocks become more valuable or less valuable depending on what your overall goal is. In this case, they wanted to make it 25 times more valuable so that it would stay above that $1 valuation that was required to stay trading. And so it made it so that every stock that you owned, if you had 25 shares, now it became 1 share. And it made it so that the stock price went from $1 pretty much up to $25. It's a way of artificially inflating the stock price. And it's pretty common when it comes to stocks that have gone down significantly or ones that have become too large that want to stay at a reasonable stock price. And so that meant that if you own 25 shares of the stock, it would now become 1, and it makes it so that it artificially changes the stock price. This was a stock that seemed to be on its last legs, and a lot of people were betting against it. It's the idea that you see a stock that is in dire straits and you're hoping that it's going to go to zero and you're going to make a lot of money from it. And when you do this, it's called short selling, and Robinhood did this accidentally. In their process of buying and selling stocks for the platform, they accidentally sold short on the stock that proceeded to go up significantly in value, at one point going up 3 times its initial stock price in a single day. So now we need to talk about what short selling is and how this put Robinhood in a really awful situation. So when you buy and sell stocks, you're hoping that the stock price is going to go up. You want to buy it low and you want to sell it high. It's a classic phrase that pretty much everyone knows when it comes to investing in the stock market. So that's how you benefit if the stock price goes up, but how do we benefit if the stock price goes down? It's called short selling. It's the idea of borrowing shares from your broker, selling them with the expectation that you're going to give back those same number of shares to the broker within a certain amount of time, and there's a fee associated to borrowing that stock. So the goal is that say you bought a stock for $10, you sell it with the expectation of giving it back in the future, and it goes down to $1. So now you have $10, you have to spend $1 to buy it back, and you make $9 of profit, and that's how you make money from the stock price going down. But it is costly, so the longer that you sell these shares short, the more it's going to cost you because the broker is going to eventually want their money back. Not their money, they want their shares back. They really don't care about the stock price. So when something aggressively goes in the opposite direction, you have to buy back your shares. So the danger here is the stock price tripled in value, and the people that were short selling it had to buy back their shares to close out their position. And anytime you have additional buying pressure, the stock price is going to continue to go up. This is how we get a short squeeze, which is the idea of the people that were expecting the stock price to go down are actually the ones that are propping up the exponential rise in price because they have to buy back their shares to close out their position. So as the stock price went up significantly, Robinhood realized their mistake and had to buy back their shares to close out their short position, which just meant that the stock price can go up and up as the buying pressure continues. And the big danger of short selling is that you can have an infinite loss. If I buy a stock at $100 and it goes to zero, I have 100% loss. I've lost all of my initial investment. But when you're short selling, you have an infinite loss potential. Say you sell it short at $1 and it goes up to 10, now you have to buy it back at 10, so your initial investment was $1 and now you're losing $9 total, including your initial investment. So you're down 1,000% or whatever that ends up being. And so there's huge loss potential, which is how we end up with Robinhood having a larger loss in the stock than it's actually worth by the end of the day. Because Robinhood had to buy as the stock price was going pretty much vertical, and then as it went down, the stock price and the valuation goes down significantly. And so the loss that they accrued was $57 million, and the valuation by the end of the day was $54 million. Okay, so now I've explained what happened, but why were people happy about this? Because I think that's the funniest part of the story. If a normal broker did this, it'd be like, oh, okay, why? That's a big mistake. But with Robinhood, people are laughing. Robinhood has a tumultuous history when it comes to retail investors. Something similar happened with GameStop back in January of 2021. It was a similar situation where people thought GameStop was going to go bankrupt. The short selling was very aggressive, and when they had positive news, it shot up the stock price. And as we mentioned, as these people have to close out their short positions, they have to buy into the stock, which pushes it up even more. And during that time, people were buying aggressively. This is a time when retail traders, or just people like you and me, were getting more involved in the stock market than they ever had before. And Robinhood decided that they needed to limit the amount of people that could buy options, borrow, or just buy the stock in general. And this pissed off a lot of people, because as you see the stock price going up and you're not allowed to get in, think about like the Arthur meme of standing on the outside of the bars just wanting to get in, but you can't because Robinhood has put up this rule that they're not allowing people to buy more than a single share at a time, and that pissed off a lot of people. You still have people to this day that will not use Robinhood because of the decisions that they made that impacted them negatively. And now as we have this huge story where they're losing $57 million, being on the opposite end of a short squeeze, people were pretty happy about it. And one thing that you need to remember about the internet as a whole is that they hold grudges and they hold it for a long time. So people were pretty pleased when they found out this huge mistake, because that's what happens. That's kind of karma, as some people would say on the internet. So this was the story about how Robinhood made an accidental mistake that lost them $57 million, which ended up being worth more, or a bigger loss than the overall stock was worth. They could have just bought the whole company if they really wanted to, but instead they had this huge loss because accidentally they sold the shares of Cosmos short. So let me know what you thought about the story. Do you think they deserved it? And let me know what stock or topic you'd like me to discuss in a future video. If you made it this far, I'd really appreciate it if you hit that like and subscribe button. I will see you in the next video. Thank you for watching.